All right. Hey, I want to welcome you to today's episode. Boy, we have got an exciting, power-packed episode today. You are going to want to strap in for this. Tom Wheelwright, CPA. I know many of you know him, needs no introduction. He's well known, but just kind of giving you some background on Tom. He's, of course, CPA, CEO of Wealth Ability based out of Tempe, Arizona, best-selling author of Tax-Free Wealth. If you've not read that yet, you've got to get it. He's also author of multiple books, including Why the Rich Get Richer, and then also a rich dad advisor to Robert Kiyosaki, and really been a significant part of his team in providing the tax and advice and strategies to them as well. And then, good Lord, he's been featured in Wall Street Journal, Washington Post, Forbes, Investors Business Daily, and every major network that you can think of. So again, just the list of accomplished goes on and on, farther than what I could read. So Tom, we're awesome and grateful to have you here on today's show. And we've got an exciting topic that we're going to be talking about now. And again, it's funny, right? A lot of people don't get excited about taxes, but I do, because I know if you can use the laws in your advantage, then you're coming out ahead. And that's one of the things, Tom, I know you're a master at. And so today we're going to talk about the 5 real estate tax deductions that a lot of people, not only investors, but even unfortunately, maybe the CPAs they work with and accounting firms they work with, are not really dialed in to know about. So again, I'm excited about this. And listen, for you guys and gals that are watching and listening, you make sure you take good notes. You're going to be able to really get some great things out of this. So Tom, again, welcome to the show. Glad to have you on board.
Well, it's great to be here, Andy. Always love talking to investors and people who are looking at the possibility of real estate, especially, the 2017 tax law was very much in favor of real estate. I actually remember I was in Washington, D.C. when the 1986 Act was passed.
Oh, wow.
And real estate got hammered in 1986. That's where we got the passive loss rules. We had the whole savings and loan debacle as a result. And in 2017, lo and behold, 30 years later, it is completely the opposite. So unfortunately, like you say, a lot of CPAs do not understand this law. And in fact, we train now hundreds and thousands of CPAs so that they do understand it. That's actually our mission right now, is to train the CPA profession, because we found not only do investors not understand it, their CPAs aren't understanding it.
For sure. Well, I know when you and I first met, Brad Sumrock, who's a friend of mine and a neighbor on the beach, you're his personal tax advisor, and of course, speak at his events and all like that. And just love the excitement and passion that you have for this. And, that's really what I was like, man, Tom, I got to have you on the show, just because we talk with a lot of investors that invest with us, and even the folks that are listening, they, want to find out more about how we do such great things with our investing strategies. But a lot of times, and that's exactly the truth, when we talk one-on-one on the phone and we start talking through some of the benefits of the apartments and the tax depreciation strategies and all those different things that you're going to cover a lot of here today, they're unaware of. And then even too, a lot of times as we develop a relationship with that person, their advisory firm, it's like, my guy he wasn't too sure about that. And that's like, I'm like, okay, well, let me just do this. I recommend you've got to talk to another firm that knows this stuff. And that's, that's not a knock against any of those guys, but it's so true.
No, you have to, you kind of have to look at the CPA profession like you would the doctor or lawyer. I mean, you wouldn't go to a chiropractor for heart surgery, right? You wouldn't go to a neurologist for heart surgery either. So what most people think is they think, well, a CPA is a CPA. Everybody understands the law the same, and that's not true. Real estate is a real specialty in the tax law. It's very complex in the details of it. I mean, we'll explain that the basic concepts are not that difficult to understand. Yeah. But the details, they require some really digging. I mean, I was in the regulations this morning. I'm looking at opportunity zones, and boy, that's an interesting area. There's one that, of course, we'll want to talk about, because that's a big one for real estate, and it's very complex, and we don't have all the rules. So it is something where sometimes we have to, what we call it, upgrade. Sometimes we have to get an upgrade in our team.
Yeah.
And when we upgrade our team, then we upgrade our results.
Oh, yeah, you nailed it. I mean, a lot of times I talk with guys, and that's the thing. They've outgrown the advisor they were working with. It was a good match then, but they've grown their business, or they've grown their medicine or practice or whatever it is. And then now there are things that they're accomplishing are kind of beyond that level. So, well, let's dive in and talk about, what are these top 5? What does that look like?
Well, so, the biggest thing that happened in the 2017 tax law was the bonus depreciation, right?
Yeah.
I mean, this was huge. And here's why it was so big for real estate. Previously, it only applied to new equipment.
Mm-hmm.
Okay. And it didn't apply to real estate. It didn't apply to residential real estate at all.
Yeah.
So it didn't apply to residential real estate, and it didn't apply to used property. Well, now it applies to both. So now, and it's pretty amazing. I mean, I travel the world with Robert Kiyosaki, and I always look at the tax laws in other countries, and we are one of the few countries that allows any depreciation on used property.
Yeah.
And not only do we allow depreciation, we allow bonus depreciation. So first of all, make sure everybody understands what we're talking about. Depreciation is simply the deduction that you get for the wear and tear on your property. That's really all it is. You don't, get to deduct the entire investment because the building's going to last, the property's going to last for a long time. So really what the law looks at is they look at, okay, there's really 4 basic components or groups of things that you buy when you buy a piece of real estate. You buy the land, you buy the building, but you also buy the land improvements, which includes all of the landscaping and the driveways and the fencing and the carports and the lighting and all of that kind of stuff, which there's a lot of, and it also includes all of the contents of the building, which includes the window coverings and the floor coverings and the, lighting and cabinetry and all of those things. Okay. And even the washer dryer hookups, things like that. Things that are not really part of the building. They just make life better for those who are there in the building, whether it's residential or commercial. And so what the tax law does is they say, well, look, some of those things wear out faster than others. So land, so I like to joke, even the IRS knows that land doesn't wear out.
Yeah.
Right? So there's no depreciation deduction for land.
Yeah.
And buildings wear out over a long period of time. So the tax law says that they're going to allow a deduction over 27 and a half years for residential, including multifamily, and 39 years for commercial.
Yeah.
Then land improvements don't last so long. We all know. Now, for some of us, landscaping lasts a lot shorter time than for others because we don't take care of it.
Yeah.
But
Especially Arizona, you're just stuff out there, man.
You got to make sure you get enough water and you got the sun in the right place, right? So you got to have the right plants. But truly, landscaping is it's a big expenditure. It's a big part of the value of what you buy.
Oh, yeah.
And so that's actually historically depreciated over a much shorter time, 15 years. And then you have the contents that are typically wear out over 5 to 7 years. So what the new law said is it said, look, if it wears out in less than 20 years, we're going to give you all of the depreciation the first year.
Wow.
And that's whether it's new or used. So that means, consider this. Look, let's say that you put down 25% on a multifamily building.
Yeah.
Let's use simple numbers. Let's say it's just a little fourplex and it's $1 million.
Yep.
Okay. Well, if you put 25% down, you're only putting down $250,000.
Yeah.
Well, the building and the property though, that is $1 million, and you get benefit. You get the tax benefit for the money you borrowed as well as the money that came from your pocket.
Yeah.
So you get the whole $1 million of purchase price, basically the cost to depreciate.
Yeah.
Well, if you go in and do what we call a cost segregation, which breaks down all of these different types, components, then what happens is you're going to typically find that somewhere between 25 and 30% of that property value is in the land improvements and the contents. Okay, so if you do the math on that, let's say it's 25%, that means that you put down $250,000 and you got a $250,000 deduction the first year.
Yeah.
where else can you get a deduction for your entire investment?
Yeah, that's amazing.
And still own the investment.
Yeah.
Right? I mean, yeah, you could spend your money in your business, but then the money's gone.
Yeah.
If you put the money into real estate, the real estate's still there, and you still get the deduction, and you get not only your portion of the deduction, you get the bank's portion of the deduction. And this is something, I'll tell you what, last filing season, I was literally on the phone with so many syndicators.
Yeah.
Like yourself, right? So many people who put together deals and they did not understand this. Their accounts did not understand this. I was seeing the K1s come through, depreciation come through, where it was like, 10% or 5% or even, small numbers. And I'm going, what's wrong with this picture?
Yeah.
So I literally have conversations both with the syndicators, because my clients are investors, right?
Yeah.
My clients are investors in these deals,
Yeah.
and I'm having to do the work.
Yeah, you're having to straighten it out.
Right? I'm having to make sure that this gets done right, because I want my investors to get the tax benefit.
For sure.
And it's just something that I don't understand why it's so, poorly understood. But I'll tell you what, I'm just not seeing a lot of real good comprehension out there in the commercial marketplace.
Well, and that, that even too raises another great point too. And I see that as well, because like with all of our properties, we're dialed in and understand that we enter into that cost segregation study we actually have with a national firm. They just know as soon as we close, bam, it's already on their list. They're going out there. They're doing 3 of them for us on complexes here. I think in 2 weeks, I saw on an email that just came through. And
Right.
And it really is what you just hit on. There's people that are in the investment arena, and yet though they don't have the full understanding, and again, the tax component is a big part of it. And to be able to advantage and leverage that for the benefit of investors, like the folks that invest with us, they're getting, 40, 50, 55% deduction, typically speaking, on their K1, because of that cost segregation and stuff, versus somebody where they're getting, like you said, 10%, and then now you've got to jump in and kind of fix it,
Yeah. So I mean, think about how big a piece this is for the investor.
Oh, yeah.
The first year, I mean, you're going in and rehabbing the property, et cetera, and they're probably not getting cash flow that very first year.
Mm-hmm.
The only cash flow they're getting is the tax benefit.
Mm-hmm. Yeah.
So, and the tax benefit, I mean, think about that. On $250,000, if you're in a 40% tax bracket, that's $100,000 tax benefit.
For sure.
Which means that's a 40% return on investment in on day one.
Yeah.
Not just year one, but on day one.
Yeah.
If it's done right. And it becomes such a big part of the investment return that, you can't anymore, compare investment returns from real estate with investment returns in the stock market. Because in the stock market, the best you can do is not have the gains taxed immediately, right?
Yeah.
Or taxed. You can do a Roth IRA, Roth 401k, and you can not have it taxed, but you're never going to get a deduction for it. If you get a deduction, then you have to pay it back down the road.
Yeah.
So real estate is just a unique situation with this bonus depreciation. That if you're looking at an investment and they're not doing the cost segregation and they're not doing this properly, you really need to challenge, frankly, the syndicator and say, what's going on here? I need to make sure that I'm getting my tax benefits.
Yeah, for sure. No, that's so true. And I think it's just even too, like you said, about having the right advisors, the right team that understands, how to maximize the results. Really, that's really what it is. And so, and I think about even too, and I know Brad has said this, publicly and kind of announced it from the rooftops, that by him connecting together with you and gaining that understanding, that he himself personally saved over $1 million, and that's the power of what this can do. Now, again, maybe your situation where you're listening, you're not going to save $1 million and buy a whole complex, but by investing into this type of real estate, just like Tom said, the results are astronomically better because of the tax advantages than what you may get in a stock investment or a bond or a loan where you're making a kind of hard money loan or something of that nature.
Right. So we probably got to address, because a lot of your listeners I know are passive investors
Yeah.
in syndicated deals. So we probably ought to address this passive loss issue, because this is something I get all the time. I was in Dallas a couple of months ago,
Yep.
and what I heard was, well, my tax advisor says I don't get these deductions until the property gets sold because I'm a passive investor, and so they're not deductible. I'm going, well, then they're probably not explaining to you exactly how the law works. Okay, so a passive loss, yes, it may be passive to you because you're not a real estate professional, but a passive loss can offset passive income.
Mm-hmm.
And the question should become then, how do I convert some of my active income to passive income?
Yeah.
And that's where you really have to have the good tax advisor, because they have to be looking at your entire picture. This is why we always start a new client going through a comprehensive strategy, a plan of action for reducing taxes, because you can't just look at one piece of it.
Yeah.
If I just looked at the one piece, I'd say, yeah, you're not going to be able to use these, but I don't know the rest of your situation. So the question should always be not, can I use it, but how can I use the tax benefit? And once you start, and your advisor should be talking in those terms. Okay, here's what you have to do in order to use these tax benefits. Are you willing to make these changes? Is this okay? Does this work? And normally what we find is that we can get other benefits, estate tax benefits, other types of even family planning benefits, family financial planning benefits that we wouldn't ever do if it weren't for the tax law encouraging us to do it. There's actually our philosophy at Wealthability is that not only is the tax law a series of incentives for reducing your taxes, it's actually a roadmap for making money. Yeah. Because your finances improve when you follow the tax law the way it's supposed to happen. Not just because you have more money that you can invest. That's a big deal. That's that's what Brad learned, right?
Yeah, exactly.
Look, you have $1 million extra. What can you do with that?
For sure.
Probably buy a $4 million property if with that. And by the way, you get tax benefit on the $4 million property too. Going. So it just keeps going and going and going. So that's one part of it. But the other part of it is you actually end up making better decisions, okay, if you're really following the tax law. For example, one of the, another one that on our list here on our top 5, one thing that people miss a lot is the home office deduction. And the reason is because their tax lawyer says, well, it's not that big of a deduction, it doesn't help that much. But really, and it's, first of all, it's specifically in the tax law, so it's not a red flag, okay? It's specifically in the tax law. Second of all, if you do it right, actually, it's not a red flag at all, just because it's not even reported to the IRS if you do it right. Yep. And thirdly, there are other tax benefits go along with it. But first of all, it has to be a business deduction. So the key is anything can be deductible if I make it a business deduction. Yeah. And the way to make it a business deduction, the way to make it a business deduction is pretty simple. You have 4 tests. It has to have a business purpose, a business reason. It has to be ordinary, meaning it's typical in your business. Yep. It has to be necessary, meaning it's going to make you a profit, and you have to document it. Well, think about the financial benefits of following those 4 rules. Not the tax benefits. Think about the financial benefits. Yeah. If every dollar you spent had a business purpose, was typical and not over the top, right? People get in trouble when they buy fancy offices. I see you're in your home office there. I'm in my home office here, right? We're both doing this. We're both in a small office. We're not in fancy offices. People do that. Well, if it's over the top, it's not ordinary. Yeah. Right. Well, it's also not making you money. So, and if it's necessary, by definition, it's profitable. So if it didn't meet those tests, the question that I always ask is, should you really be spending that money in the first place? Yeah. Okay. Because if it doesn't meet those tests, it's probably a frivolous expense and it's not going to make you money. So you're always going to make more money if you follow the rules that the tax law has set out. And one of those is, look, if you have a home office, the IRS actually, I know this is completely contrary to what everybody's always heard. Yeah. The IRS or the tax law wants you to have a home office.
Wow.
Okay. And here,
wow. Right. I mean, because so many times that's what you hear in the street, so to speak, or other people. It's like, oh, well, don't put that on your taxes. That's a red flag for an audit. And it's like, that's not really the truth, but that's kind of like, what people think.
well, let me show you how much the IRS wants you to have a home office. If you think about, your automobile expense, pretty much everybody knows that the portion of the time that they drive their car for business, they get a deduction, right? Either a mileage deduction or an actual deduction. And I think most people understand that when you commute, that's not deductible. That's considered personal by the IRS. So that means even if your first trip of the day is to a rental property, or even if it's to a customer, that's a commute. And the last trip of the day is a commute also. Well, the IRS is very specific in their instructions that if you start your day at your home office, your commute is the 30 feet to your kitchen, from your kitchen to your office. Wow. And if you end your day at your home office, your commute at the end of the day is the 30 feet from your home office back to your kitchen. Because we all know that our days start in our kitchen, right? Because it always starts with coffee and ends with wine. Yeah. My wife calls those the bookends to her day, right? Coffee in the morning, wine in the evening. Yeah. Well, if your commute now is that 30 feet, then that means that first trip outside of your house is no longer a commute. Now it's business. Wow. For most people, that will almost double the deduction for their automobile if they have a home office. Wow. If they don't have a home office, they don't get that deduction. Wow. And so, this idea that the home office is not encouraged, all the IRS wants to do is make sure that you're not taking home office when you shouldn't have a home office. Yeah. I mean, I will tell you, the office I'm in right now is in my home, but it does not qualify as a home office because there's a bed in this room. It's a Murphy bed, but it's a bed, and I have guests that are not business guests stay there. Mm-hmm. So therefore, this does not qualify. It's not exclusive. I'm never going to take this, even though I use it 98% of the time for business, I use it 2% of the time for personal. Yeah. And because I do that, it's not a home office. Now, I have other rooms in my home that are solely office. I don't use them for anything else. Yep. They're exclusive. Well, so they qualify. So I always start my day in the morning with at my home office, and I always end it at my home office. Now, I spend most of my time in my home office because I actually find that I get more done in my home office. Now, I have an office. By the way, here's another thing people misunderstand. You might have an office outside of your home, okay? That you might go there to meet clients or to meet staff, to have meetings, to do other things. But you actually, what I'm guaranteeing most people don't know is that you can have two offices. Mm-hmm. What we have to do is make your home office your primary office, okay? And if we do that, then the other office is your secondary office, and actually traveling from your home office to your secondary office is deductible. Wow. So, and when you combine this, now I'm going to bring back in bonus depreciation. Yeah. Now we have bonus depreciation on cars. So even a passenger car, the first year you get $10,000 of bonus depreciation if you use your car 100% in business. Well, if you don't have a home office, there is no way you can use that car 100% for business because you're going to have a commute every day. Yeah. So you're not going to get all of that bonus depreciation. Now, bonus depreciation on trucks, which a lot of real estate investors have, big SUVs or big trucks. Okay, that's it's important to what they're doing. And now trucks, they don't have that $10,000 limit. You get bonus depreciation equal to 100% of the purchase price. So consider this. Wow. You're at the end of the year. You're thinking about buying a new car. You're going, I need that new truck, that new SUV. And let's say it's $60,000. That's actually not a very expensive truck or SUV anymore, but it's $60,000. And you put $0 down on that truck or SUV. If you have a home office and you're using that truck or SUV only for business, then you could get a deduction up to $60,000 the first year. So here's what's happening. You're borrowing $60,000 from the bank. you're getting at a 40% tax rate, you're getting a 24% tax benefit.
Wow.
And you are out no money.
$0 out of your pocket.
$0 out of your pocket, $24,000 into your pocket, right? Now, do you have to pay for that car, that truck, or that SUV? Absolutely. You're going to have to pay for it. But if you're using it right for business, again, business purpose, ordinary, necessary, documented, right? You need to make sure you document those miles. But if you're using it for business, guess what? You actually are going to produce income as a result of having that vehicle.
Wow.
So that income that you produce from having that vehicle is going to pay for the vehicle. So you get the tax deduction up front.
Yeah.
I mean, think about how all this was working together here. You know, people think, here's what I hear. People go, well, my tax advisor says home office, there's just not many deductions there. Well, by itself, it's not entirely true, but it's not that big. That's not that huge of a number. But when you add in the bonus depreciation and automobile and all these other things, what a lot of tax advisors especially miss is that the tax law is a living, breathing organism, and all the parts work together. It's like, could you have a brain without a heart?
Yeah.
Right? Could you have a hand, right, without without organs? You can't do that. And the same is true with the tax law. It's a living, breathing organism, and all of these pieces work together. And what happens is people have accountants tend to be very linear. We go A to B to C to D, right? We always come, most accounts come down the line. When the tax law isn't built that way, it's very nonlinear. And so we have to start looking at it differently and just realize that, it's not that hard.
No.
It's really not. It's a matter of, how do I make it deductible? If I'm going to change, as I always say, if you're going to change your tax, you have to change your facts. And your advisor's job is to just tell you what facts to change. That's it. And then you decide, do I want a home office or not?
Well, I love the fact, too, a friend of mine is president of John Maxwell team, and I remember John saying, great answers come from great questions. And I love hearing you. See, this is what's so different, too, and again, for you guys who are listening, a lot of times advisors will say, no, you can't do that. And then what you're saying is, how can I do that? Here's what it is. And then not only that, but then you're saying, how can I look at the whole picture and see how we can then adapt or change the facts to conform to what the picture is. And so that's so key for those of you guys who are listening, getting the right questions. And again, so oftentimes, and I see this so much, where I talk with somebody, they talk with an advisor, and the advisor says, now you can't do that. And it's like, instead of saying, how can I do it? Because you raised a great point, too, about the question of how can I create passive income to offset those passive losses? Because there's plenty of people where maybe they own a law practice, a medical practice, a business. There's different opportunities that may exist there for them to be able to create a passive income structure, and just what you said, how can I do it? And so that's, I would almost say very few, it seems like from my experience, ask those kind of questions.
Well, it's I was actually doing recording my own Wealth Ability Show podcast this morning, and what was really clear is that we're just not conditioned to asking those questions. We're not conditioned to really thinking about and we're not conditioned to having an accountant. We typically, an accountant sets up their own practice, typically because they want to own their job. Yeah. Okay, not because they're an entrepreneur. In our network, we have a network of 20 CPAs, 20 CPA firms right now, and it's growing on a daily basis. But in our network, what we look for is CPAs, accountants who are entrepreneurs who happen to be accountants. Yeah. Not accountants who happen to own their own business. Yeah. And so if you want somebody who's going to think like an entrepreneur, I mean, really, you can't do this, you can't do that. An entrepreneur would never, ever think like that. If you thought like that, I mean, think about it in your real estate. Yeah, if you thought, well, you can't do that. Yeah. Well, you'd be paralyzed from day one. You'd never be able to get anything accomplished. I mean, you have to go through zoning. You have to go through, red tape. You have to go through banking, finance. Oh my heavens. seriously, I am refinancing my home right now. And I am literally, I had a full head of hair before I started this refinance. And you look at it now.
It's true.
It's unbelievable what they put you through. And if I just said, well, you know, you can't do that. I'm going, well, look, okay, how do I do it? How can we get this done? In fact, I even told the my mortgage broker, who's been my mortgage broker for many, many years, I said, look, I am not doing this again unless you figure out how to get this done easier. That's what entrepreneurs do, right? Yeah. The job of an entrepreneur is to solve a problem, not create a problem. And it seems like a lot of advisors, whether it's tax advisor or legal advisor, their whole mantra is let's figure out what you can't do. Yeah. Let's protect you from yourself. Let's make sure that you don't make any mistakes. That's not what entrepreneurs want. I've never met an entrepreneur that wanted anything except tell me how to do what I want to do.
Yeah, how to get the result.
How do I get the result? What do I have to do to get there? Right? and let's figure it out. Okay. Now you may not want, there's the other point where the juice isn't always worth the squeeze, right? Yep. So you have to look at that too. That's not your advisor's job. Your advisor's job isn't to tell you the juice isn't worth the squeeze. Your advisor's job is to tell you, here's how to get the juice.
Yeah,
right?
Sure.
You decide whether you're willing to, to squeeze hard enough to get that juice out of it, or whether it's not worth it to you. I mean, the $24,000 tax benefit from your, from a bonus depreciation on your truck may not be worth it to you. If $24,000 isn't worth it to you, don't do it.
Yeah.
Right.
Sure.
Don't do the home office. Don't do these things. If you're like most entrepreneurs, you're going, look, every dollar that I can keep is a dollar I can invest.
Exactly. Yeah, for sure.
Right. Then I'm going to do everything possibly that I can. So anyway, that's that. But let's go on to some of these other tax things. I know we've got a limited amount of time here, but there are some amazing tax opportunities. Another one we were talking about before we started the show was the opportunity zone. And a lot of people have heard of this opportunity zone and they really don't understand it. And frankly, I don't even think the IRS understands it. Yeah. Not their fault. I think the law was really poorly drafted. And so let's see if we can make it pretty simple, because we're at we're coming to the end of the year here. Yep. And so people are going, maybe too late to get into a real estate investment. What can I do? Because I had a big gain. Either I sold a property or I sold stock. Mm-hmm. I have some kind of capital gain. Now that's the first key. It has to be capital gain. And people go, and maybe it's even that they were in a syndication, right? And syndications never do 1031 exchanges. I've never seen a syndication do a 1031 exchange. That's a case where the juice is not worth the squeeze, right? Yeah. And so they don't do 1031 exchanges. So now I've got this gain. What do I do about this gain? And I can't. In one answer, of course, is, by the way, take the money and invest in a new deal, because then you get the bonus depreciation. Remember, bonus depreciation, as long as you've placed that property in service by December 31st, you get all of the bonus depreciation. Yeah. So you only have to have it in service one day and get all that bonus depreciation. You only have to buy that truck on December 30th. You buy that truck, you get the bonus depreciation. Yep. So, you do have that option, but some people are going, well, I don't want to put all the money. I'd really just like to put the gain into something else. Okay. Mm-hmm. I'd like to take my principal back out. I have other uses for it. I want to just put the gain. Well, this opportunity zone, this is something that, you really don't see a lot of people talking about. I'm going to tell you, here's another one where I think the tax law is creating a financial opportunity that some people are going to be multi-millionaires as a result of the opportunity zone tax benefit. Because here's what happens. If you take the gain, let's say you got $200,000 back, right, from the sale, but only $50,000 was a gain. And you go, okay, I'd like to invest $50,000. Well, you take that $50,000 gain, you put it into an opportunity zone fund, okay? What happens is that $50,000 it gets deferred. The tax gets postponed for till really until either you sell the deal or until the end of 2026. Right? So you get to defer that for a very long period of time. And on top of that, the appreciation in the property, if you hold it for 10 years, is tax-free.
Tax-free, yeah. That's huge. Tax-free.
It's a huge tax benefit. But here's what I think is missing when people talk about this. They're always talking about the tax benefits, right?
Yeah.
The tax benefits are fantastic. But think about, where's an opportunity zone? It's in a place, it's in a part of town that is just on the edge of becoming a good or a great part of town. Yeah. So it really is, that's where the opportunities are. The opportunities aren't in the Class A neighborhoods. No. The opportunities are in the Class C neighborhoods that are struggling to become Class B neighborhoods. That's where they are. So this is a phenomenal opportunity not to allow the tax law to encourage us to do something that is good for the community. I mean, I'm looking at what's going on in Oakland, California, for example. Oakland it's a war zone down there, right? Yeah. It's been a war zone for years, and yet you have these areas in Oakland that are opportunity zones, and you're starting to see, even now, already, you're starting to see this redevelopment going on.
Yeah.
I think you're going to see more and more redevelopment. I think these are enormous financial opportunities. Yeah. You know, if this is part of your strategy, right? If this is part of your wealth strategy to do this, I think that in an opportunity zone, you find the right one. I think these funds are going to be huge.
Oh, for sure. And that's key too, I think, is like what you said, is finding the right one. I've seen some that, you know, they're kind of out in the sticks and it's not really a great area. They're hoping that money's going to come there. So maybe not the best place, but then I look where our office here, you know, we're in Tampa Bay, Florida. So we're actually in Largo, right by the beach. And downtown Largo has always had a little difficulty gaining traction. It's a good area, but it's just like a downtown. And so that's been designated an opportunity zone. And now you see there was a building that's going up, being completed there, and then 2 more combo retail apartments going up there for exactly that reason. You know, that they're going to hold it 10 years. The investors will be tax-free. So a lot of that benefit that's there that, and I think too, what you also say, there's misinformation, because I see that too, like an apartment complex deal will come through our desk, through our underwriting team, and, you know, oh, it's an opportunity zone. Well, it's like, yeah, but it really doesn't, because the buildings are, it doesn't qualify, because you're not going to be able to put the money in to really, you know, upgrade it to make it qualify. So, but I think the very least is what you said, is being aware of it is a starting point, because again, unfortunately, some firms, they don't have that awareness, even to where the guy says, hey, to his advisor, what can I do? You can just put money in a, you know, 401k or, you know, something along those lines, you know, and not really seeing the breadth of other options that may be available. So, you know, it's great to be able to dive into some of these and, you know, see that there's more available for people because of these tax law changes that took place.
Right, exactly. And that's really what we're trying to do, is want to make sure that everybody is familiar with what's possible given these new tax law changes. So, I mean, for example, there are some people that they're a little afraid right now of the market being so hot, and there's so much money going after these deals that they're going, do I really want to leverage, you know, go into high leverage situations? And so some people are going, you know what, I'm actually going to buy deals cash, because I don't want to be so highly leveraged, because I'm worried that we're going to have another, you know, 2008, 2009 is going to come along, which we all know it's going to happen, because real estate's cyclical, just like the economy. And so we know it's going to happen. We just don't know when it's going to happen. Yeah. And so I know a lot of people are quite concerned about their leverage right now. And they're going, look, maybe I want to do some cash deals. Well, if you do cash deals, guess what? You're going to have taxable income from that property. If it's a well-managed property, because your depreciation after your first year isn't going to be enough to offset that income. But here's the good news. The good news is that real estate now qualifies for this new 20% deduction. We call it a qualified business income deduction. And so this is good news for the cash investors. You know, a lot of cash investors say, well, I'm going to do this through my IRA because it's a cash investment. And it's, you know, because IRAs, of course, you don't typically do real estate because you can't leverage through an IRA. So they're going, well, I'm doing cash investment. I'm going to go through an IRA. But what you miss in there is that you're taking income that could be low taxed or no taxed income. You get a 20% deduction off the top. Whereas if you do it through your IRA, when you eventually pull that money out, you're going to pay ordinary income rates.
All the tax, yeah.
You know, so you're going to pay tax at 100% of your ordinary rates. And people go, yeah, I'm going to be in a lower tax bracket. I'm going, why?
Yeah. The goal is I'm going to retire and have less money and be broke. Exactly. That's not the goal.
Right. Exactly. It actually, the whole idea behind the IRA or 401k is that you're going to retire poor.
Yeah, exactly.
It only works if you're going to retire poor. I mean, if you think, and I think about, okay, now let's say that I retired, which I will never, but let's say I did. Okay, what would I want to be doing? Would I want to be traveling coach? No, I want to be traveling first class. Sure. Am I going to be traveling more? Yeah, of course, because I want to take my grandkids. I want to go to places. I want to vacation. Hey, when I'm on a cruise, do I want to be in the bottom, you know, in those bottom interior cabins? Are you kidding? That's like, you might as well stick me in a prison cell and throw I've done that. Yeah. I did that the very first time I did a cruise.
That was the early days. That's not, you don't want to return to that.
Oh my heavens. And then you get a cabin and you have that has a balcony and you're looking out on the ocean and you go, wow, this is beautiful. I love this experience, right? Yeah. And it's just a whole different world. Well, why would you want to travel second class, third class with coach when you could travel first class? And the reality is, if you're making as much money, is it true that you don't have as many regular expenses? Maybe. Okay, because your house may be paid off. Hopefully, if you're lucky, your kids are gone, right? They're not living in your basement.
Exactly.
But so you might have some fewer expenses, but you're going to have additional expenses if you're lucky, because you're going to be traveling and doing, playing golf at first class golf courses, and joining the country club that you never really were able to have time to do. I mean, all of these things that we want to do when we retire, and if we are making less money, then we're not going to have that, which is why I love real estate, because I'm going, okay, real estate, I can have basically my cake and eat it too. I can get all my tax benefits without having the handcuffs that the government puts on you when you're in an IRA or 401k. So I love, I always love being on shows like yours, Randy, because I just know that the more people we can talk to about, okay, what can we do if we build true wealth? Absolutely. And we really are financially educated, we can reduce our taxes without having the government tell us what to do. For sure. Right? And we can have freedom. I mean, think about this. So people have a 529 plan, right? Which is, by the way, the dumbest idea ever imagined by Congress. Yeah. And you're getting like 0.5% return on a year on your money, or maybe a 1%, maybe 2%. Yeah. And you can only use the money for education. So you're going, but how do I build a retirement fund? How do I build a fund for my child's education? Well, what about real estate? Absolutely. What about real estate? Can't you use that money for your child's education? Actually, here's another thing that happened in the 2017 Tax Act is we got a new standard deduction. It's $12,000, which means the first $12,000 that you earn is tax-free. Well, it also means the first $12,000 that your kids earn is tax-free. That's, opportunity right there. There's your opportunity. So if you have a business or you're a real estate investor, then why aren't you hiring your kids? For sure. Why aren't they working in your business? The government actually is encouraging you to have your kids work in the business. The money they earn up to $12,000 is tax-free. The next $10,000 is basically taxed at 10%. So they have these really low tax rates. On top of that, by the way, if the business is entirely owned by you, let's say that you're a real estate investor and you've got a partnership that's owned by you and your spouse, there's no Social Security tax when you pay your child that's under 18. Yeah. So that tells me that the government is wanting you to hire your kids. And if you think about it, it's good for the government. to have your kids learn how to work. It's good for you to have the kids learn how to work. They learn your business. I mean, think of all the benefits. I mean, I grew up working in my dad's print shop. He had actually a fairly sizable printing company. And every one of us, I have 5 siblings, and every one of us worked at the plant. And I loved that experience, and we all have memories of that experience. And that was such a great experience for us. My mother worked there too. She was the controller. That's where I first got my
accounting. You got the taste of the numbers
from my mother.
Yeah.
And we all worked in the business. So family businesses, I'm a huge fan of them. I had a great experience growing up, and I think that they can be a tremendous learning experience for the kids. And the government obviously thinks that too, and will reward us accordingly.
Incentivize that. Well, it's so exciting. I mean, like even the things you're talking about I'm so glad for the people listening to be able to hear this, because like we've had one of our younger guys, he invested with us in a deal for his kids' college. That was his kids' college plan, to put money with us, and then it will just roll from deal to deal as we, do deals over the next 20 years. And that's how he's going to pay for his kids' college and have them with a seed money for their own business. And then even too, the thought of like so many folks listening I deal with too are entrepreneurs, and like, man, why not have your kid work? Our daughter, she's 15. She works in our business 1 day a week. And she started, good Lord, she started investing with us with her Christmas and Easter money and birthday money, where she saved it up. And I said, well, hey, you could get, 15% return here investing with us in this deal, or you can put it in the bank and get 1%, and showed her what that meant. She's like, I want to go over here. And it's like, so the more that people hear about these things and really it opens their eyes to see what's possible, praise the Lord. That's really what I'm about, is helping more people. And again, I mean, we've had people that have invested with us now 17 years that have made double-digit returns, preserve their capital, and it's been done through real estate. And that now with these tax advantages, it just, hands down, I believe, promotes that real estate is a superior investment vehicle for people to accomplish their goals. And I'm glad to see that you guys are expanding your network too, because more people need to connect together with advisors like you that can help them. So for the folks that are listening right now that, they want to find out more, what would be the best way to connect together with you or your advisory team so they could learn how they could more benefit and what steps they could take?
So we'll make it really simple. It's wealthability.com, just like it sounds, Wealthability. Our mission is to help you enhance your ability to create your own wealth. Instead of turning it over to Wall Street or somebody else, you can create your own wealth. So it's wealthability.com. And like I said, we have a network of CPA firms. We work with, we have firms that work with people that are just starting out. They're maybe, consultants, or they may just be starting in real estate, all the way up to very, very sophisticated, multi-million dollars a year income level people that we can work with. And so, that's our mission in life, is really expand how many people we can serve, because every time I travel with Mr. Kiyosaki, or I'm, at Brad's event or some other event, the number one question I get is, how do I find somebody that can do this? Because obviously I can't take on that many clients. I only have 30 clients, and I'm not looking for clients. Okay. That's not my primary business. So what we want to do is we want to make it available to more people. And here's the other thing to understand, is that how you do your tax planning has a big impact. So it's the process. Yeah. You might even find somebody who really understands real estate, and they're still not reducing your taxes on a long-term basis, because they're not taking you through the proper process. It's a step-by-step process that we use. We've developed this process, and when you go through the process, we actually had somebody, they actually went behind us, and they went directly to one of our CPA firms, and they came back to us complaining. They said, well, I went to one of your CPA firms, and I didn't get what you said I was going to get. And we said, well, you went directly to them. You didn't go through the wealthability process. Yeah. It's not understanding the tax law that makes that's not the only thing that makes it work. You have to understand the process for reducing taxes. There's a whole series of steps that you have to take to make sure everything gets done right, to make sure that you're going to get an overall reduction in your taxes, not just today, but you don't want to just get a tax reduction today. If you want to do that, just go max out your profit sharing plan. You know, if what you want is a lifetime of not paying taxes, you really want to build what we call tax-free wealth, that's where you have to go. There's a process for that. So, you know, if we can help you with that process, and whether you just want to get some education on it or whether you want some professional advice, we are happy to talk to you at Wealthability. We don't charge you a dime for you know, for finding one of these firms. We do that as a free gift to you.
Absolutely. Well, and that's what I love too, Tom, when we connected together and met, that you really are excited about the mission of helping people in this arena. And it really it's a kindred spirit. I mean, we're on a mission to help people gain, you know, financial freedom through real estate investing, and then having that tax planning and strategy that couples together with it is such a critical piece. So I'm so glad to be able to have you on the show today and to have folks listen to it and for their ability to connect together, because again, it's undoubtedly going to help them really gain a place of getting to obtaining tax-free wealth. So, hey, thank you so much for being a part of the show and for coming on and sharing all this expertise with us today. Thank you so much. You have a blessed day today, Tom.
Thank you for having me. It's been great being here. Thanks.
Awesome. Awesome. Thank you.